objective number 3 would come next, but I just want you guys to go through and read this on your own time. So you can open the textbook, read pages 9 to 12. The information there is more theory. It is important, but I would just be reading it to you. So you might as well just read that on your own time, and I think you'll get the understanding that you need from that. We are going to move on to learning objective 5. We will come back to number 4. I'm just doing this in a bit different order than the textbook. Learning objective 5 looks at what financial statements are prepared and how do we go about preparing them. These are the 4 statements that get prepared by businesses, and they're listed, as you can see here, in the order of preparation. The first one that we will look at is the income statement. The income statement presents a summary of revenues and expenses of an entity for a period of time. What are these items? Revenues are amounts earned by delivering goods or services to customers. So amounts earned by delivering goods or services to customers. So you'll do the work, you either sell someone some type of product or you go do a service for them and you earn that revenue when the work is done or when the good is delivered. Expenses are day-to-day costs incurred when running a business. So day-to-day costs incurred when running a business. There's going to be various types of expenses and maybe revenues. There may only be one type of revenue, but definitely various expenses for businesses. And these are all laid out on the income statement. And the math that is done on this statement takes all of the revenues minus all of the expenses. And from this, we are left with net income. So that is what is being calculated on the income statement. And it may also be referred to as net profit, just another way of saying the same thing. But for our course, we'll typically call it net income. Now, another important thing to note here in the definition is the income statement is prepared for a period of time. Now, if we take a step away and think about revenues, for example, if someone were to tell you revenues were $1 million, well, that $1 million needed to be earned over a period of time. So maybe it was over a month, over a year, who knows, but it had to be earned over a period of time. Same with expenses. They're not just right now. It lasts or spans over a period of time. So that when you see an income statement, it always states what the period of time that they are discussing. This slide shows an example of an income statement from the textbook. So all of the financial statements we look at will start with these 3 items in the header. So you'll always start with the name of the business. You'll name the statement that you're creating. In this case, we are creating the income statement, and then it'll state the date. So for the month ended April 30th, 2019. So that's telling us that the period of time is 1 month that ended on April 30th. We always list revenues first on the income statement, and then following that, the expenses are noted. In this case, there's only one revenue account, so we just see service revenue. Whereas with the expenses, there's 3 different ones here, and it does give you a breakdown of the total expenses. So if you had more than one type of revenue, you would say service revenue. Maybe it was broken out into 2 different types of service revenue. If they had those, it would then show total revenue as well. And as I noted, we start with revenue, we subtract all of the expenses to get down to our net income. So that is what we are calculating on the income statement. We're looking to find that net income value. Now it goes through in these bubbles a little bit about the formatting of the statement. So for our class, I'm less concerned about exact formatting. And as you're doing my lab assignments, it will format it for you. But on the final, say you were told to prepare an income statement, I'm less concerned with if you have the 2 columns as you see here, or if you were to move these all over and have just it in 1 column. That's fine. The biggest thing for you guys to know in our course is revenues come first. You would show a total revenue. The expenses come next, total revenue, to get us to net income. All right, so we are going to look at an example of an income statement. And the first one we're going to look at is for a service company. So we'll pretend we are the owners of a barber shop and we only provide services. We don't sell any products. So think about this. Take a minute. What would our revenues be if we were a barber shop? What kind of expenses might we have? And let's go through and fill these into an income statement. So if we start an income statement, the first thing we will do, as I noted, is we're going to name the company. I'll just say barber shop. We'll name the statement that we're creating, which is the income statement. And we'll note the date. So for this example, we're going to say it's for the month ended December 31st, 2019. And to note, I'm just going through as if we're making this up. If you were asked to create an income statement, you would be given the values here. When we're doing this, we always start with our revenues, as I said. Oops, sorry about that. Revenues. What kind of revenues as a barbershop would we have? Oh, I heard someone say we would have haircut revenue. Right, that's a good one. And we may also have hot shave revenue. So a man goes in and gets his beard nice hot shave done. We'll say we had $10,000 of haircut revenue and $500 of hot shave revenue. So here, since we've got 2 types of revenue, we need to show that subtotal. So our total revenue for this month is $10,500. From there, we will note our expenses. So I'm going to call these operating expenses because they're the expenses related to the operations. And you'll see in a minute why I'm specifying operating expenses here. Okay, can any of you guys think of expenses that would come with running a barbershop? Right, rent would be one. They're going to rent the space. Rent expense is $2,000. There would be salary expense, actually paying the barbers to do the services, it's $3,000, and supplies expense. So the shampoo that they use, the razors for the hot shaves, that type of thing, $2,000. So that's all that they've got. Again, we're going to note our total operating expense do the math here, that's $7,000. And now we're going to take away our expenses from our revenue. So our revenues minus our expenses get us to net income. 10,500 minus 7,000 is 3,500. So a couple things just to note on the formatting. I've done these lines here. It's more just because I know what the formatting looks like. This would be fine if you were to just have it kind of look like this. You're showing, the 10,000 minus the 7,000 gets you to net income. So as long as you've separated revenues first, then the expenses gets you to net income, that's great for our course. In the real world, when we look at ordering items, so the expense items here, for example, there's really no set way to do it, but typically it's done the way I've done here, which is in alphabetical order. That is what we did when I was at MMP. For all statements, we would order expenses in alphabetical order. But again, for our course, just get all the expenses in there. Doesn't matter to me what operating expenses, what order they're in, as long as you've got them in the right place. Okay, so if we get to a positive number at the end, it's called net income. But I also want to just quickly erase a couple numbers and change our example here. So we'll erase these two. So let's imagine now that the landlord increased our rent and it actually ended up being $5,000 for rent. And the barbers, they went on strike, they demanded more money, and salaries ended up going up to $4,000. So now our total operating expenses are $11,000. If we take the $10,500 of revenue minus our $11,000 expenses, we now get a negative number. And in accounting, you'll typically see those in brackets. So whether they're square or round brackets or how I did them with a point, whichever, it doesn't matter. But in brackets means it's a negative number. And in this case, this would say it's a net loss. So our barbershop actually lost money this month rather than having any income. Okay. So next I want to go through quickly what income statements look for businesses that sell goods. Now I'm adding a little bit extra here. We will go into far more detail on this when we get into chapter 5 and 6. But I think it's good to see now right away what a couple of different income statements could look like. So our barbershop was just a service company. We just had revenues and operating expenses. When we look at a business that sells goods, however, we're still going to have revenues and those operating expenses, but now we'll also have cost of goods sold, or sometimes referred to as cost of sales, but typically cost of goods sold, or as you can see here, often shorted to COGS. So these items, the cost of goods sold, are the direct costs to produce or purchase the goods that are sold to customers. And the biggest thing to note right now is that these are only the direct costs. So what is directly related to producing or purchasing those goods? No other costs, only what is directly related. And when we have these businesses selling these goods, we break down the income statement into a bit more detail. So we'll go through an example of that next. For this example, we are now going to be a company that purchases shoes and resells them to customers. So we're not going through the production. We just purchase them wholesale and then resell them to customers. So again, first thing we do, name the company ABC Shoes Inc. We're still creating the income statement. So we name that next. And we tell the period of time, which we'll just say it's for the year end April 30th, 2020. So with an April 30th year end, this must be a corporation, because when corporations file separate tax returns, which we talked about in the forms of business area, they can choose any year end that they want. So this company has chosen April 30th. If it is a proprietorship or a partnership, because the income is reported on the personal tax returns, those are always filed on a calendar year. As you file your tax returns, whether you have a business or not, it's always January to December. So proprietorships and partnerships, their year end is always December, whereas a corporation can choose any single day in the whole year. Okay, so we always, again, still start with revenues. So even if we're a business that sells goods, we'll still start with revenues. In this case, we've got sales revenue. So from selling shoes, we are making sales. We'll have $800. So maybe this is in millions, so 800 million, but just for ease, we'll say 800. And because we sell goods, we now immediately break out the cost of goods sold portion. So this is those direct expenses. So we've got our shoes that we're selling. So these are the direct costs of purchasing those shoes, and that's $600. Now we immediately show a subtotal, and this is called the gross margin, which is $200. So this gross margin is the money that you made just from selling shoes. And it's what remains now for you to pay the rest of your operating costs that you have. Below that, we now again go back to what we've seen and we break out the operating expenses. So these are more expenses related to running the business, but they weren't directly linked to the cost of those goods sold. So here we have rent expense. So we need to have a storefront to sell those shoes. The rent for that goes in operating expenses. That's $50. We have salary expense for our shoe salesman, $30, and also utilities to run the store, keep the lights on. Utilities expense is $10. So because we've got multiple items here, we'll show our total operating expense. Which is $90. And that gets us now to our net income. So the gross margin, we've already subtracted the cost of goods sold. Now we subtract our operating expenses and we get to $110. So a business that sells goods has this extra step in here where we're calculating gross margin. And as I said, it's just extra information for the users. Because when we started the slide or these videos, that's what I told you, that There's so many users who are looking at these statements to make decisions and to get information. So having this gross margin broken out just lays out right here extra information for the users. And gross margin is often part of managerial accounting. They would be looking at this before they go into a year and thinking about, okay, if we know we've got rent of 50, we know what our salaries are going to be because we know how much we pay our employees, how many hours they're going to work. Utilities are typically the same month over month. They're kind of going to know these operating expenses ahead of time. So now they can figure out how many shoes they need to sell and how much this gross margin needs to be to cover off all of their operating expenses. So in managerial accounting, you would look through that. It's called break-even calculations to figure out how many do we need to sell just to break even, and then if we have a goal of the net income we want, how many would we need to sell at that point. So again, as I said, I'd like to show you now that there's more than one income statement, but we will dive deeper into gross margin and cost of goods sold in Chapter 5 and 6. But for now, that's just a quick look at the income statement, and we will go through some more examples when we have our live class.